This course, The Survey of Accounting, is an introduction and survey of accounting as a discipline. The accounting as a discipline has been described as the language of business. I would encourage you to think about this as a foreign language. The basic approach to a foreign language is to learn your vocabulary, to learn the grammatical rules, to begin to practice, to try out your ideas of how things are supposed to work, and then you gain proficiency. In this course, we're going to cover both the financial accounting, the balance sheet, the income statement, those things. And we're also going to cover topics in managerial accounting on how some of this information is summarized and used by management. So I would encourage you to get started with the material. I'm going to give you a basic overview right now on financial accounting. Some of the terms that you no doubt have heard at various points are assets, liabilities, equity, revenues, expenses. So let's talk about each of these briefly. As a general rule of thumb, assets are things that you own that will benefit you or your company in the future. The value of the asset, the recorded amount of the asset, is referred to as the cost of the asset. What you gave up to obtain that asset determines what the cost is. Usually, what you give up is money. So you pay money and you get an asset. You can then use that asset in the future. As the asset is used and is used up, the value of the asset is converted from a cost to an expense. The expense then is an analysis and summary of the costs that have been used up. The liability is the flip side, which is a dollar claim, a dollar amount that you owe that you will pay in the future. Of course, you could settle up by giving something other than cash, but most people do pay their bills in cash. There have been situations where someone gave a different asset to a creditor and the creditor was satisfied. But generally speaking, you're going to pay your bills in cash. The equity is the owner's position in the company, and in the accounting equation we say that assets must equal liabilities plus equity, the owner's equity. And this is common sense. Another way of looking at this is we have all the things that we're working with, and who provided the financing to obtain those things. The financing came from either a creditor, in which case it would be a liability, or from the owner, in which case it would be the owner's equity. So that's the basic balance sheet. The type of assets that we might have would include cash, inventories, any items that we pay in advance, buildings, land, machinery, that kind of thing. Those are the assets. The liabilities might be credit extended by a supplier, maybe a bank loan. We could perhaps issue a note or a long-term bond to obtain financing. On the owner's equity, we have different kinds depending on the nature of the company. If it's a corporation, you will have stock that is issued to the owners. If it is a partnership, you will have partnership interests where the partners each have their own equity base in the company. And if it's a sole proprietor where there is only one owner, then that owner owns everything, all the equity. So that's the basic scheme. The revenues are the sales price that you obtain when you sell your item or perform your service. And the expenses then are the things that you use up while trying to obtain revenues. And you have the difference, the leftover part, is an increase in equity. And on the income statement, we call that the net income. So that's the basic scheme. You can think of the increase in equity each year as the same as net income. And before we develop the income statement to analyze how this change happened, the most common way of measuring net income was to add up all the assets at the beginning of the year, all the liabilities at the beginning of the year. The difference was your equity. At the end of the year, you add up all the assets, subtract off all the liabilities. If your equity went up from year to year, then you made money. If your equity did not go up, if it decreased, then you realize that you did not make money. You're worse off. So gradually over the years, we developed the income statement to explain what the changes were in your equity account so that you could better manage your business. Well, that's my introduction. Just get on through the chapters, and I will have assignments posted shortly. They should already be up by now. Thank you.